Noir Plasma Chrome Bleed. Unlocking knowledge, inspiring innovation, empowering curious minds.
This website makes learning so easy. I found all my resources here.
Like what you share.
All right, let's get right into this explainer. Today, we are looking at the global financial system not just as a dry set of rules, but as a massive, deeply complex engine. Think of it kind of like this. Auditing is the diagnostic software that's constantly scanning for errors. Your accounting standards, they act as the highly detailed operating manual, and the capital markets themselves are the moving parts, spinning at absolute lightning speed. It's an incredible machine, and today, we're going to pop open the hood and see how it all connects. Okay, let's map out our journey today. Section 1 covers advanced auditing in AI. Section 2 is global IFRS convergence. Section 3 tackles capital market microstructure. Section 4 explores derivatives and risk management. And finally, Section 5 ties the whole shebang together with the integrated governance framework. Section 1, advanced auditing and AI, the diagnostic software. You know, modern auditing has dramatically shifted away from just manual routine testing into these comprehensive technology-driven risk paradigms. And the absolute foundation of this shift is ISA 315, specifically the revised 2019 standard. It's a strict mandate requiring auditors to identify and assess the risks of material misstatement. But here's the catch. They can't just look at the numbers anymore. They have to develop a really deep, operational understanding of the entity, its macro environment, its specific reporting framework, and its highly complex IT structures. This forms the essential baseline for literally all further audit procedures under ISA 330.
A core part of that assessment is the inherent risk spectrum. And listen, inherent risk isn't just a static checkbox. It's a fluid continuum based on 5 very specific factors. So, an asset valuation relying heavily on management judgment, for instance, that hits high subjectivity. When risks get pushed up to the extreme end of this spectrum across any of these factors, they officially become significant risks, which demand highly specialized procedural responses.
Now, what's really fascinating here is how these 3 audit risk components completely interlock in practice. You have inherent risk and control risk, which are both assessed by the auditor. But detection risk, that's what the auditor actually controls. And it's an inverse relationship, like a seesaw. If a company's inherent and control risks are sky high, auditors absolutely must lower their detection risk to keep the overall audit safe. How do they do that? Well, by expanding transaction sample sizes or shifting their testing away from interim periods right up to the critical year-end. But right here is where our diagnostic software gets a massive upgrade. Traditional sampling always introduces sampling risk. I mean, you might randomly miss the one fraudulent transaction hiding in a batch of 1,000. But with AI and forensic data analytics, we can now execute 100% population testing. Process mining actually reconstructs exact operational workflows to find bypassed controls. Predictive analytics uses regression models to automatically flag variance gaps in revenue. And anomaly detection, it deploys machine learning to isolate statistical outliers, like, say, someone posting a massive journal entry at 3 a.m. on a Sunday. You just can't hide from that. Section 2, Global IFRS Convergence, the Operating Manual. So, shifting our focus from internal audits to external reporting, let's talk about how international accounting standards codify these complex business models into a single operating manual. Enter IFRS 9. This standard fundamentally overhauled how financial instruments are classified, requiring 2 highly specific operational tests.
Step 1 is the business model test. Is the company holding the asset just to collect cash or to collect and sell? Step 2 is the SPPI test, which verifies if the cash flows are solely payments of principal and interest. Depending on how an asset navigates these two tests, it gets slotted into one of three measurement categories: amortized cost, fair value through other comprehensive income, or fair value through profit or loss. IFRS 9 also brought us the expected credit loss, or ECL model. We are completely done with the old, backward-looking incurred loss approach. Now, assets migrate through three stages: performing, underperforming, and credit impaired. And there is a massive structural consequence right here in stage 2. If a recession hits, banks see a significant increase in credit risk across their portfolios. They are immediately forced into stage 2, meaning they have to recognize lifetime expected credit losses instantly. That hits their bottom line and regulatory capital overnight. This immediate capitalization hit is exactly why bank stocks can plummet so violently at the mere whisper of an economic downturn. Moving over to multinational operations, we run straight into IAS 21, which dictates how companies translate foreign operations into consolidated statements. Because you're translating net assets at a closing exchange rate, but the income statement at average rates, you naturally generate a functional balance sheet variance. This variance doesn't just hit the profit and loss statement immediately. Instead, it accumulates safely in equity as the foreign currency translation reserve, or FCTR, sitting there until the foreign operation is eventually disposed of. Which brings us to Section 3, Capital Market Microstructure, the physics of the moving parts. All right, let's zoom out even further into the actual open market. We are leaving the world of static financial reports and entering the rapid, microsecond physics of liquidity and order execution. Contemporary capital markets generally operate on two structural execution frameworks. First, you have order-driven markets, where buyers and sellers match on a public limit order book. Then you have quote-driven markets, where designated market makers commit their own capital to provide liquidity. But market makers face a major, constant threat: adverse selection from informed traders who hold private information. The Gloston-Milgram model perfectly illustrates this. When market makers suspect they're trading against informed counterparties, they widen their bid-ask spreads to protect themselves. So the absolutely crucial point here is, how do we actually measure that liquidity drain? That brings us to Kyle's Lambda from the famous 1985 Kyle model. Lambda measures illiquidity and permanent price impact per unit of net order flow. If a market has a high lambda, it means market depth is incredibly shallow. A single large trade will cause a massive, permanent swing in the asset's price because the market is just highly, highly sensitive. To fight back against the harsh realities of Kyle's Lambda, institutional investors deploy algorithmic execution strategies. The objective here is to take a massive parent order and quietly slice it into tiny, unnoticeable child orders over time to minimize that permanent price displacement. They use algorithms like TWAP, time-weighted average price, and VWAP, volume-weighted average price, to execute trades under the radar without spooking the market makers. Section 4, Derivatives and Risk Management, the shock absorbers. With all these market risks and price impacts flying around, the system desperately needs shock absorbers. Enter the Black-Scholes-Merton formula, the absolute standard quantitative foundation for options pricing. Now, it might look a bit intimidating, but it is an elegant piece of financial engineering. By plugging in the spot price, the strike price, the risk-free rate, time to maturity, and asset volatility, market participants can accurately price European call and put options. This allows them to precisely reallocate market risk. Now, to manage those complex options portfolios, traders rely on partial derivative sensitivity metrics known as the Greeks. Let's run through these really quickly. Delta measures sensitivity to the underlying asset's price. Gamma is the rate of change of that delta. Vega measures sensitivity to volatility. Theta tracks time decay as the option approaches maturity. And Rho measures sensitivity to the risk-free interest rate. Basically, these metrics act as a lightning-fast dashboard for market makers to navigate portfolio risk. But here's where things get really fascinating. Think about the feedback loop. To maintain a delta-neutral hedge, market makers must continuously buy and sell the underlying asset. But if liquidity drops, meaning Kyle's Lambda is high, their own continuous hedging consumes whatever little depth is left in the order book. The very act of managing their risk actually amplifies the spot price volatility of the asset itself. It becomes this continuous, self-reinforcing feedback loop. Finally, Section 5, Integrated Governance Framework, the grand synthesis. let's move to the grand finale and see how this all builds together. This beautifully illustrates that auditing, international accounting, and market mechanics aren't just isolated subjects. They're one massive, interdependent ecosystem. ISA 315 audit risks must perfectly align with IFRS 9 macroeconomic forecasts. IT general controls act as the critical backbone for both AI audit testing and high-frequency algorithmic trading. Multi-currency translation reserves under IAS 21 are directly managed by active derivative hedges. And those derivatives? Well, their delta hedging strategies are entirely bound by the microstructure constraints of Kyle's lambda. It's all connected.
Which leaves us with a pretty compelling question to wrap up on. As AI algorithms advance to flawlessly test 100% of audit populations, and high-frequency algorithms dictate the exact ebb and flow of market liquidity, is the future of financial governance entirely in the hands of the machines? It's a profound thought to end on today. Thank you so much for joining me for this explainer, and I highly encourage you to keep exploring these fascinating systemic intersections.
Like what you shared.
This website makes learning so easy. I found all my resources here.
Noir Plasma Chrome Bleed. Unlocking knowledge, inspiring innovation, empowering curious minds.